This is the study session on portfolio management and the reading on portfolio risk and return. This is part 2, which is really just a continuation of part 1. Let me just remind you of how much fun we had in part 1. Let's see if we can keep the jocularity going. Let me go ahead and remind you where we ended on that last couple of slides in part 1. Remember, we're in a Harry Markowitz world where we're examining these risky securities like shares of stock, and we put them together in what Harry Markowitz called the efficient frontier, which is the maximum expected return for each given level of risk. And the important thing about that efficient frontier was that the relationship was a curve. And then at the very end of part 1, we introduced a risk-free asset. And we asked the question, we said, boy, we're going to introduce a treasury bond or a treasury bill or some other risk-free asset. What does this do to the risk-return relationship? And boy, we found out that it tremendously changed it. In fact, the relationship becomes a line. And that's where we started talking about this capital allocation line, which is a combination of all those risky assets and the risk-free rate of interest. Let's go ahead and draw that capital allocation line. Notice that standard deviation is on the horizontal axis, designated by the lowercase sigma, and expected return is on the vertical axis. So, of course, we're not going to start at the origin. We're going to start up the vertical axis by the risk-free rate, and then we're going to go up and to the right because, of course, the founders of finance decided very early on that the only way to get more return is to take more risk. So that's an upward slope, and it is a line in the presence of the risk-free rate of interest. And I'm going to show you that mathematically here in just a second. All right, let's explain the relationship between the capital allocation line and the capital market line. The capital market line is a special case of the capital allocation line. You could take just 10 stocks or 20 stocks or 50 stocks, and you could do this 100 times with 50 different stocks every time, and you would come up with your own unique capital allocation line. But the capital market line is a special case where the market portfolio is on the Harry Markowitz's efficient frontier. And the capital market line then is the line that is tangent to the Harry Markowitz efficient frontier. So that market portfolio is efficient. It's also on the capital market line, which is a really fascinating result, by the way, is that in the presence of a risk-free security, the capital market line now becomes the new efficient frontier. Now let's go ahead and ask the question, what is the market portfolio? I always think of it as if you owned one share of stock of every publicly held company that's out there. And that's kind of a broad example of what the market portfolio is. But in general, most professionals think of the market portfolio as a broad and diversified domestic stock market index. Now, here's this beautiful picture I was promising you. There, we still have total risk on the horizontal axis. There's the expected return. In this case, it's the expected portfolio return on the vertical axis. There's our nonlinear, our curved efficient frontier. And the market portfolio is represented by that star. And so what investors do is investors decide that they're going to invest in the market portfolio because it's on the efficient frontier, and then they're going to move along the capital market line. So that capital market line is really the tangent point from the risk-free rate of interest on the vertical axis, even though I don't have it labeled over there, and it's sloping upward and to the right to reflect the risk-return trade-off. And so that capital market line is now the new efficient frontier because you would prefer any of those portfolios on the capital market line to any of the other ones on the Harry Markowitz efficient frontier because for a given level of risk, they have a higher expected portfolio return. And of course, the exception is the market portfolio. Now remember that the capital market line is really just a special case of the capital allocation line. Now let's go ahead and take a look at some formulas here. Let's compute the return on the capital market line. That's just going to be a weighted average. So the expected return on the portfolio is going to be the percentage invested in the risk-free asset, and then 1 minus that percentage invested in the market portfolio. And so that's what we're going to do. Let me go back to that previous graph. And I have another graph here in just a second, but I want to say that what we're going to do is we're going to start at that starred market portfolio, and then we're either going to move to the left by buying treasury securities or lending capital to the government, or we're going to move up to the right, and the only way we can do that is through some kind of leverage. We'll talk about that later, though. All right, so that first formula is the formula for the return on a portfolio anywhere on that capital market line. And that's just a weighted average, so that should be fairly straightforward. But the question then becomes, what happens to the standard deviation of a portfolio that's on that capital market line? Well, what I did here is I cut and pasted the formula for portfolio variance of two assets from our previous reading. And so that thing there should be familiar. That's the variance of the portfolio. And notice that I bolded in red the variance of the first asset, and then way over to the right, the standard deviation of the first asset. Well, that's going to be the variance and the standard deviation of the risk-free asset. And so what do we know? Risk-free asset has no standard deviations. It's risk-free, right? So that standard deviation is going to be 0. So the first term drops out, and then the third term drops out, and all we're left with is that middle term in yellow. And so skip down a line, calculating the standard deviation of the portfolio for the capital market line. All we're going to do is take 1 minus the weight in the risk-free asset, which is the second weight. That's how we noted it in the previous slide, times, and now we have the standard deviation of the market portfolio. There's that specific case. Now here's the deal. The fact that that first term falls out and the fact that the third term falls out, that makes this relationship linear. And here's the equation for the capital market line. We start with the expected return on the portfolio, and our vertical intercept is going to be the risk-free rate of interest. And then we're going to weight the standard deviation of the portfolio way out there on the right of the parentheses by the slope of the line. And so look in that numerator, the expected return on the market portfolio minus the risk-free rate of interest. Remember what we called that? We called that the market risk premium. That's in the numerator, and we're going to divide by the standard deviation of the market portfolio. So really, in parentheses, that slope is really just teaching us what we learned back in, when do you learn lines? 5th grade, 7th grade, whatever grade that is. You kind of take one step to the right and then one step up. And so this should make perfect sense that what we're doing is we're moving, here, let me go back to this thing here. We're moving up that capital market line based on our relationship between how much extra return we're demanding for each level of risk. And the cool thing about the capital market line is that each step is fixed. The slope is fixed. That's what it means to be a line. Now, here's a quick example. Let's suppose that we have risk-free return of 10%, return on the market portfolio of 30%, and a standard deviation of the market portfolio of 40%. We can easily go ahead and substitute those numbers in there and compute the expected return on the portfolio. Now here's that illustration I promised you a few slides ago. Notice what we're doing there. The starred portfolio is the market portfolio. So that's if we invest 100% in the market portfolio. lots of investors, lots of candidates, lots of professionals think of that market portfolio as the S&P 500 index. And, that's not entirely academically correct, but it's okay to substitute that in there. So think about how easy it is to get to the market portfolio by buying an S&P 500 index fund. And then what you're going to do is that if you want to, you can lend your capital to the federal government by buying treasury bonds. And you're going to move downward and to the left on that portfolio. And so if you'll be there at 75% or 50% or 0%. And that's what this illustration shows, that you can locate yourself anywhere on that capital market line, even upwards to the right, using some leverage, like maybe a margin account or maybe shorting some securities or maybe using some derivatives. So you can get anywhere on that capital market line. And remember, and this is important, that capital market line is now the efficient frontier. That's why lots and lots of investors, they like to invest in solely Treasury securities. And of course, that means that they have very low tolerance for risk. But here's the comforting fact, is that those investors are located on the capital market line, and those securities are efficient. Why do you think the U.S. federal government gets away with lending, oh boy, what's the total debt of the federal government now? $22 trillion, because those securities are efficient. If they were inefficient, then there's no way the federal government could borrow that much. All right. Moving on to the next LOS. Let's go ahead and look at the difference between systematic risk and unsystematic risk. First of all, I always define risk in terms of variability. And so I think of systematic risk as the variability in stock returns due to changes in economic or system factors. I have some examples there, things like inflation and interest rates and business cycles, et cetera, et cetera. We drew this graph back in the part 1. That was the rectangle. And so there's no way that an investor can select a portfolio of risky securities and not be exposed to systematic risk. Non-systematic or unsystematic or idiosyncratic risk, on the other hand, has the potential to be eliminated through this concept of diversification. So I like to define unsystematic risk as the variability in stock returns due to changes in firm-specific factors. Things like brand name product lines, things like a strike, things like major advances in technology that allows for oil discoveries and fracking and maybe hiring new and highly skilled executives. But here's the important thing. That was that unsystematic risk. Do you remember from our previous video? That was the triangle. And what happens to the triangle as we diversify, as we get out to 30 or 50 or 80 stocks, whatever it is, we're going to virtually eliminate that non-systematic component. Now remember here that investors are only compensated for bearing systematic risk. That's why, and I've said this multiple times, if you hit that Pennsylvania Powerball for $400 million, you're not going to invest $400 million in Procter & Gamble stock or McDonald's stock or Merck stock, even though those are great companies and they're probably going to be around for quite some time, but they may not. Look at a company like Sears. They were a gigantic company years and years ago, and now who knows what's going on with them. All right, so the follow-up question then is, why is there no compensation for bearing that diversifiable risk? And we're going to talk about that at length as we move through this slide deck. But the easiest way to answer that is to ask you to take a look on the difference between the relationship between price and return. Here's an example, a quick example. Let's suppose we have a 1-year bond, and we know that value is going to be $1,000. And let's suppose that that current price is $930. Well, we could do the math and figure out what the return is on that $930. But let's suppose that for some reason the price was $970 instead of $930, and we could compute that return as well. But clearly, if you pay less for the bond, if you only pay $930 and you're going to get $1,000 in a year, that return is higher. Now, if there were some demand for that diversifiable component, then everybody would want this particular bond, and they would push the price up and push it up and keep pushing it up until it reached 1,000, and then maybe even beyond $1,000. I don't really know what infinity means in terms of mathematics, but clearly the return would be zero. And since we know there are positive returns out there for stocks and bonds and other kinds of securities, well, there is no compensation for taking unsystematic risk. Now, we're going to continue to talk about this in the future slides, but that's really just a basic explanation. All right, here's the next question in the next LOS. What we want to do is we want to form a portfolio based on a given level of risk. Well, it's reasonable to say, all right, if we take this much risk, how much return can I reasonably get? And one way to do this is through these return-generating models. So what we're going to do is we're going to try to estimate the return of a particular security given a set of inputs. And those inputs, of course, are going to be related to the stock market, related to the bond market, or related to the derivatives market. I mean, I'm not going to say something like, hey, let's put together a return generating model by me going out to my backyard and counting the number of trees that I've planted since I moved into this house. Of course, that model would be completely worthless. So we're going to select relevant and appropriate inputs for these return generating models. So let's start with a multi-factor model. Let's pick some various factors, some macroeconomic factors like interest rates, like exchange rates, like oil prices. Let's pick some fundamental factors like maybe dividend yield or price earnings ratio. Let's pick some statistical factors like standard deviation or covariance or moving averages. Now, the important part is that those factors are related. In fact, they are correlated with the returns of the security. So what we're going to do is we're going to estimate those economic factors. We're going to collect that data and put that into a return generating model, a multi-factor model, and we're going to estimate the return on a portfolio. Now, a simple way to do this is through a single index model. And so this is just one factor. And what we're going to do is we're going to go back to stuff that we've just talked about with Harry Markowitz, with the capital allocation line, with the capital market line, and here in just a little bit we're going to talk about the security market line. So notice the formula there. We're going to try to solve for the expected return on a portfolio. We're going to start with the risk-free rate. We're going to consider the total risk of the portfolio, and then we have to measure it by some slope or some factor in there. And so that's what we're doing. If I take the risk-free rate on the other side, and if I do a little algebra, I'm going to take the ratio between the standard deviation of our portfolio I, or our individual security I, divided by the standard deviation of the market portfolio, and I'm going to call that a factor weight or a factor load. And that's going to reflect the ratio of the individual risk of our asset versus the market risk that's out there. Now, a direct application of this single index model is the single index market model, where I take the return on the individual securities out on the left, that's the R sub I, and then as the input, I use the return on the market portfolio, like the S&P 500 index. And years ago, I won't tell you how many years ago, when I wrote my dissertation, I used this single index market model to estimate the beta. That's the beta in there. That's the slope of the line for about 2,200 different publicly held corporations. But that's a really cool way to come up with the beta of an individual security. Now, what's even cooler about this single index model is that you can compartmentalize it into its systematic component and its non-systematic component. Now, go ahead and look into the very first blue formula there. The variance of returns, remember that's just the standard deviation squared, can be expressed in the following. All right, let's look at that first expression. We're going to take the beta squared times the variance of the market. We're going to add the variance of the error term, and then we've got to put 2 times the covariance on the right-hand side. But the covariance between the market portfolio and that error term is going to be 0, so that thing falls out. So all we're left with is the second formula. And so look at this. The beta squared times the variance of the market, that's systematic risk. And then the variance of the error term, that's unsystematic risk. So look at how cool this is. You can divide the variance of a portfolio or the variance of an individual stock into its 2 components, systematic and unsystematic risk. All right, now I've used this term beta in the previous slides and even some other slide decks. So here we go. Here's the first explicit LOS that says, let's go ahead and calculate and interpret beta. First of all, I want you to think of beta as a measure of sensitivity. And I want you to think about it in the following terms. Let's suppose that you own just one stock, and that stock has a very high beta. And today you wake up and read the Wall Street Journal, and you read that there has been a surge in the S&P 500 index. It's gone up by 20% today. Well, the fact that you have a very high beta means that you are very sensitive to those changes in the market portfolio. So if you have a beta of, let's say, 2, then if the market portfolio goes up by 20%, then boy, your portfolio might go up by 40%. Now, it's not a mathematical relationship like that. I'm just estimating. But that's what a high beta means. If the market goes up by 10% or 20%, then you're going to go up by way more than that. And having a high beta stock is a good thing when stock prices are rising. But it's just the opposite if stock prices are falling. I mean, look at what we've had here in the United States over the last month. We've had a Dow crashing of 800 points, and then we've had a surge of 1,000 points. So what does that mean? If you have a high beta stock, that means you've got tremendous volatility. On the other hand, suppose you have a utility stock that has a very low beta, and your stock and the market portfolio goes up by 20%. Well, your utility stock might go up by 4 or 5%. It's still good news, but you are less sensitive. So I want you to think of beta as a measure of sensitivity. And I always think about it as reactions to me as a parent. Sometimes I overreact. Sometimes I say, oh my gosh, what have you guys done? And other times I say, it's okay, let's just kind of figure it out. So think of high beta stocks as overreacting and think of low beta stocks as underreacting. All right, there's a good formula for beta. It's going to be the correlation coefficient between the market portfolio and the individual asset divided by the standard deviation of the market portfolio. How about some quick examples here? What's the beta of a $10 million treasury bill? Well, are you ready for this? What did we just talk about a few slides ago? If the standard deviation of the risk-free asset of the treasury bill is 0, well, then its beta has to be 0. So remember, beta of the risk-free security is always 0, always 0. How about if we have an asset that has a standard deviation of 15%? So this is a risky asset, but it has a correlation coefficient with the market of 0. What's that beta? Well, that's still going to be 0. If it has a 0 correlation to the market, then if the market goes up by 10%, we have no idea what our individual security is going to do. It could go up, could go down, it could stay the same. But then let's take a quick mathematical example. Suppose we have standard deviation of our asset is 15%, standard deviation of the market portfolio is 10%, and correlation is 8. You can quickly insert the math there and get a beta of 1.2. Now remember, the market portfolio has a beta of 1.0. So any beta above 1.0 is one that's going to react more to the release of economic information. Any security that has a beta of less than 1.0 will react less than the market portfolio to the release of economic information. All right, let's take a deep breath here and let's switch over to the capital asset pricing model. This is really cool stuff. Capital asset pricing model was developed in the early 1960s by a guy named William Sharpe. And William Sharpe, of course, studied all the stuff that Harry Markowitz produced. He knew about standard deviations. He knew about efficient frontier. He knew about the capital market line. But what William Sharpe was interested in was to kind of determine what is a reasonable expected return on an individual stock. And that's what William Sharpe did. What he believed in was that individuals are going to diversify their portfolios. So what was important was not the standard deviation of the portfolio, but what was left. And the what was left part is the beta of the portfolio. And remember, in the previous video, I talked about beta being a measure of the height of the rectangle. Remember that investors can't do anything about systematic risk, but they can choose the height of their rectangle. If they want just a little bit of systematic risk, they'll choose stocks that have low betas. If they want lots of systematic risk, they'll choose stocks with high betas. Now, William Sharpe and others won the Nobel Prize in Economic Sciences for his work on the capital asset pricing model. There's the formula there. When William Sharpe won the Nobel Prize, it was worth $700,000. I often refer to this as the $700,000 equation because it is so simple and it is so beautiful. Notice on the left-hand side of the equation, we're solving for the individual expected return on a stock. What do we start with? We start, of course, with the same thing that the capital market line started. We're going to start with the risk-free rate of interest, and then we're going to move upwards and to the right. But instead of the slope being measured by the ratio of standard deviations, the slope is now measured by the beta of the individual security. And of course, we've got to put the market risk premium in there, expected return on the market minus the risk-free rate. So that is the equation for the capital asset pricing model. I encourage you to memorize that thing because sooner or later you're going to have to use it on an exam. Now, why did this win the Nobel Prize in Economics? For a variety of reasons. And here are the assumptions. Some of which you're going to like, some of which you might not like. Some are reasonable, some are not. But the important point is that in the early 1960s, what William Sharpe did for us is that he formalized this model and allowed us to view individual stocks using their important component risks to determine their expected returns. All right, so let's go ahead and look at the assumptions here because that's what the LOS asks us to do, explain the assumptions. So this is probably a little bit more. Explain means more than just memorize or define. So here we go. Investors are risk averse, they are rational, and they are utility maximizing. And so what does risk averse mean? In the simplest sense, it simply means that in order to motivate an investor to take on more risk, you're going to need to provide he or she with more return. Being rational means that investors are able to completely and accurately process all of the available information and then to correctly arrive at a reasonable decision based on things like beta and risk-free returns. And then the idea about maximizing utility is that all investors prefer higher returns to lower returns. Remember, in the previous reading, we talked about utility being a measure of satisfaction. And in the finance universe, satisfaction is measured by the relationship between risk and expected return. Now, here is an assumption that some people don't like. Markets are frictionless. That means that there are no transaction costs and there are no taxes. Oh boy, that sounds fairly unreasonable, and it probably is. A frictionless and a transaction cost-less market means that there are no such things as bid-ask spreads. There are no such things as commissions or fees. But it also means that investors are able to sell short. They're able to do it without any constraints on their ability to leverage those decisions. And that investors are able to borrow at the risk-free rate of interest. I'll allow you to figure out if that is a reasonable or an unreasonable one. A third assumption is that it's a single holding period. And so remember last time we talked about holding periods could be 1 day or 1 year. But this single holding period assumption is really not too restrictive. In fact, there are lots of academic articles that extend the capital asset pricing model into multiple time periods. They call that the intertemporal capital asset pricing model. So that one's less of a worry. Here's a good one here. What William Sharpe assumed is that investors not only can process this information completely and accurately and perfectly and arrive at the identical rational decision, but that all investors think alike. That's what homogeneous expectations means. That if presented with two assets, like the return on, let's say, Pepsi and the return on Coke, all investors can observe their historical stock prices and compute their historical stock returns, and all investors will then compute the same correlation coefficient and then arrive at the same decision and have the same expectations about what that correlation coefficient means. All investments are infinitely divisible. That means that you can hold fractions of assets. And this was probably a bigger deal back in the 1960s, but it doesn't seem to be as big of a deal today, what with all the different ETFs and all the different tradings. And then there are no individual or institutional investors that can influence prices by their trades. So that sixth one is that investors are price takers. How about if we explain the security market line? Well, this is nothing but a picture of the capital asset pricing model. All right, so here's a great question is what's the difference between CML and SML? And here's the big difference. The big difference is look on that horizontal axis. Back with the capital market line, we had total risk. We had standard deviation on that axis. Here we have beta. So William Sharpe is assuming that all investors are holding diversified portfolios and beta is the only thing that matters. Notice the security market line starts at the risk-free rate. It is upward sloping to the right. Of course, investors will only take on more risk. They'll only assume more beta if they're offered more compensation. All right, and so note that slope is going to be, well, just like the slope was back in the capital market line, it's going to be the market risk premium in this case. There's the formula for the capital asset pricing model and the security market line. And notice that what we've done is we've put that formula for beta in there so that you get a better sense of what that beta means. Now, in general, betas are going to be between 0 and 2. In general, they don't have to be. When I wrote my dissertation, I calculated the beta for, what did I tell you guys, over 2,000 stocks. A handful of them were negative, and some of them were over 2. And in fact, I had a couple that were even over 3. But I did it for about a 2-year period, and so all that means is that the covariance between that individual stock and the market portfolio was really high or negative during that time period. But in general, it's okay to think of betas as being between 0 and 2. All right, so make sure that you know the big differences between CML and the SML. Let's take a quick example of how to use this capital asset market line to compute the return on an individual security. So I give you a bunch of stuff there in the example. Risk-free rate is 5%, return on the market is 10%, and there's a correlation coefficient with the market, and then a couple of standard deviations. So we're not actually given beta in this particular example, although on the exam you might just be given beta, but you might have to compute it first. So that's what we'll do there. We get a beta of 1.6, then substitute that in the capital asset pricing model formula to arrive at the expected return on the portfolio of 13%. Now, at the risk of offending you, let me go ahead and just remind you to do it this way. Look, you got 10 minus 5 in parentheses. Always do this. Take the 10 minus 5, hit the equal sign, or those of you that have the 12C, you don't have an equal sign, but you can use that reverse notation. But take the difference there, then multiply by 1.6, the beta of the individual stock, and then add the 5%. The last thing you want to do is violate the distributive property of mathematics on the exam and arrive at an incorrect answer. All right, how do we apply all the stuff that we've talked about in the slide deck so far? How do we use the capital asset pricing model and the security market line? And boy, there's a bunch of different ways to do it. What did William Sharpe tell us about CAPM? What we wanted to do was find the individual expected return on a share of stock. I mean, what's reasonable? What can we reasonably expect to get out of this investment? But there are some other applications. And the first one is the Sharpe Ratio. And I bet you've heard of the Sharpe Ratio. This is a simple formula where we take the actual return on a portfolio and we subtract the risk-free rate of interest, and then we divide by total risk. And so what the Sharpe Ratio does is it gives us a measure, an evaluation of performance of the relationship between risk and return. Now that that return in the numerator, look, that's the return on the portfolio minus the risk-free rate. So that is a risk premium in the numerator divided by risk in the denominator. And of course, what we're going to do is we're going to pick the portfolios that have the highest Sharpe ratio as those that we like best. Now, the Trainer ratio was developed by this professional money manager, Jack Trainer, and he divided the risk premium by beta instead of total risk like William Sharpe does. But the interpretations are just the same. Now, at a later slide deck and a later reading, we're going to talk about these two awesome dudes named Franco Modigliani and Merton Miller. Well, that's what the M squared is here. What we're going to do is we're going to try to use the portfolio weights. We're going to try to create a portfolio that mimics the risk of the market portfolio. And we're going to use this ratio of M squared to try to determine whether or not our portfolio is a good performer or a poor performer. And if you'll note, there are some formulas there in blue in the middle that look an awful lot like stuff that we've been doing. And so all we're going to do is match the return on the market portfolio, and that portfolio that outperforms is going to have a positive M squared. So there's a good formula for M squared to probably memorize and to apply. And then Jensen's alpha will probably be our last one here of this application of the couple of slides before this. Jensen's alpha, I want you to think about this in terms of its big picture. I'm a big picture guy all the time. Think about it this way. Jensen's alpha is the actual return on the portfolio. That's what that R sub P means. Minus, and look what's in the brackets there. Boy, what does that look like? RF plus RM minus RF times beta. That looks an awful lot like the capital asset pricing model. So inside of those brackets is what we can call the expected return on that individual stock or that individual portfolio. And so what we're really doing with Jensen's alpha is taking the return on the portfolio, the actual return on the portfolio, the realized return on the portfolio, and subtracting the expected return. And so if we return 10 and we only were expecting 8, then Jensen's alpha is going to be 2. And we're going to use this, all right? So think about what we did. We used William Sharpe, we used beta, we used the market risk premium. We're going to use this Jensen's alpha to rank portfolios and the managers of those portfolios, including portfolio managers of pension funds and mutual funds and hedge funds and all kinds of funds. So this is a great application. So describe and demonstrate applications of the capital asset pricing model. This is a really good one. Professionals use this all the time. Now we can also use the capital asset pricing model to find undervalued and overvalued stocks. This is really, really cool. Let me go ahead and show you guys the picture of the security market line and how it relates to overvaluation and undervaluation. Now think of the security market line as the equilibrium point of supply and demand for all stocks. Remember all those assumptions that William Sharpe gave us a few slides ago. If all of those assumptions hold true, then every stock will fall directly on that security market line. They are fairly valued. Now, if some of those assumptions don't really work, like, oh, let's take, for example, we do pay taxes, or there is some restrictions on short selling, and maybe some others of those that you don't like, they might cause an individual stock to fall outside of the security market line. And that's what I have there with the green and the red. So let's start with the red. And let me go ahead and ask you guys a question. If you want to buy that security that is the red star, well, clearly that red star is under the security market line and it has a given level of beta, right? But you can move just directly up on the security market line and get a greater expected return. So you would never want any securities that fall under the security market line. Those are overvalued. In fact, you might want to short those. On the other hand, look at the green. Do you want these green securities? Of course, you would love to have this green security, right? So if you knew that green security was up there, what would you do? You would run to the New York Stock Exchange and buy that stock. And what would happen to its price? Its price would gradually bid up. You'd bid that price up. And what would happen to the expected return? It would fall until it's right directly on the security market line. All right, so remember this. Securities that are located under the SML are overvalued. Securities that are located over the SML are undervalued. How about portfolio construction? Oh man, we can use that Jensen's alpha to include those securities in our portfolio if they are positive, and we can use Jensen's alpha to exclude some of those stocks from our portfolio if they are negative. And in fact, what you can do is you can rebalance your portfolio by assigning higher weights to higher Jensen individual stocks or portfolios. Now, of course, capital asset pricing model is not perfect. It has some limitations. William Sharpe relied on this notion of the true market portfolio, which contains all securities and financial assets and non-financial assets that are out there. Sometime after the capital asset pricing model was introduced, there was a guy named Richard Roll who came out with his Roll's critique. And one of those was that using the S&P 500 index as the market portfolio excluded all assets that are out there that are not included in the S&P 500 index, like some small cap stocks, or maybe some emerging market stocks, or some bonds, or maybe gold, or movie memorabilia. And so lots of these things are not investable, but we have a great conversation in store for alternative assets. There we go. Of course, different analysts might use different proxies for the market portfolio. And then beta, remember I told you that I computed beta over a 2-year period, and some were negative and some were higher than 2. But if I had picked a different 2-year period, maybe they would have all been positive, maybe they would have all been around 1, who knows? And so the selection of the time period will greatly influence what the level of systematic risk is. And then of course, you guys know this, there are no two people that think alike, let alone requiring all investors to have homogeneous expectations. Now, what that means is there might be many optimal risky portfolios and multiple security market lines. And that's the basis for our future discussions on active portfolio management. Hey, that was part 2. I think that was fun. We'll do some portfolio planning and construction. That's going to be a good one too.